Hello traders, welcome back to our channel. In this video we are going to talk about decision making in trading. You can learn a good strategy, but if your trading decision is not fast and sharp, as a result of that, your performance will be poor because you will miss a lot of profitable trades. As a trader, I have shifted from swing to day trader. It's riskier because you must have a robust risk management, but I found it more profitable, and I am sticking to it. We are going to break down two setups that we shared on premium channel. The chart right here is Euro US dollar. To be honest, we didn't make a top-down analysis because, as we know, the euro is in a downtrend and has touched the historical price since 2002. We saw a strong impulse in upside direction. This type of move creates imbalance and price usually make the same move in opposite direction to fill them. We had a clear sell setup, price has touched a supply zone, and fresh point of control that is a key level and very significant. We had a strong rejection. The question is, did we enter right away? Of course not, because the risk management should have been less than 1, which is intolerable from us. In this case we use a limit order. We put a limit order at the low of the inverted hammer candle on the top, and waiting for mitigation. Stop loss above the highs and take profit at the edge of value area that correlate with a support level. As we can see, price pullback as we expected and triggered the sell entry, then dropped nicely in a corrective way. This was a short-term trade that completed in 10 hours. An intraday trade. Next setup was US dollar versus Canadian dollar. 1 hour time frame. This was our classic reversal setup that we usually trade. We have a clear uptrend with higher highs and higher lows. Then we have the break of last higher low. You can find this event in different names. Every trader tends to name it differently, but the event is the same, and was taken from Dow theory of trend change. I have explained that because I was asked a lot what is CHOCH, change of characters. It's synonym of trend change, just rebranded, in order to sound more sophisticated. Said that, let's move on with our setup. After the break of higher low, price was pulling back towards the supply zones. We have a clear zone to trade. The supplies are well positioned, with strong bearish extended range candle. It is a candle that has a large body and small or no wicks. They created an imbalance zone. That price filled and touched the supply as a textbook, perfect scenario. We are going to use the Fibonacci extension to define an AB equals CD pattern. As we can see, price is making a complex pullback. The pattern is completing between 1 and 1.27 Fibonacci extension level that correlate with first supply zone. The price dropped sharply. The stop loss can be in accordance to the first supply zone, or both of them. I personally going to recommend the second option because it's the safest one. Our goal is to reduce the losses as much as we can. So, we want to put the stop loss at reasonable levels. Of course, in this way we reduce the reward, but is worthwhile sacrifice it in some cases. For the target we chosen an imbalance zone just above the fresh demand. As we can see, the price reached the target perfectly. The target was very precise. Right after the fill of the imbalance zone, price started to show signs of bullish pressure. So, chose the target right, close to a strong level. Do not trade by hoping, because you will end up with a break-even, or sometimes, with a lost trade, that would be avoided easily. After a winning trade, I take a step back, and don't enter a reversal position at the same pair. It's just my choice, it is not my suggestion to do the same. This setup offered as a trade that can vary from 1 to 2 or 1 to 5 risk-reward ratio. But as I said before, we chosen the second option, because the stop loss of the first one correlates with a liquidity level and imbalance zone. We can trade a demand zone in two ways. With a limit order that we can put in advance, or entering at market price after a rejection. But as you can see, don't rush into a trade by entering at disadvantaged prices. It always pull back and offers you better option. Do not forget that. Thanks for watching the video till the end. See you to the next one.